Hello everyone, welcome back. Today again we are going to learn some very important concept in basics of accounting, that is accrual concept. Accrual concept is very important concept in accountancy. So accrual concept says that any income or expense related to a particular period shall be recorded in books of accounts in that period only. So what do you mean by books of accounts? Books of accounts basically means balance sheet and profit and loss account. To learn this accrual concept, I have taken two examples. So first, let us see example one. In example one, A Limited took loan of rupees 1000 from X Limited at 10% per annum interest on 1st January 2024. Interest is payable semi-annually, that is 6 month. Loan is repayable on 31st December 2024, that is 1 year. Balance sheet and profit and loss account date is 31st March 2024. So this is A Limited who has taken loan of rupees 1000 from X Limited, and A Limited will pay interest at the rate of 10% per annum to X Limited, and this interest will be paid in every 6 months. Uh, let us see the whole example in one line. This is the date when A Limited took loan. This is the date of balance sheet profit and loss account. This is the date of interest payment, and this is the date of repayment of loan. I am elaborating this example with journal entries. I am focusing very much on journal entries because in accountancy, if you are able to understand and make journal entries, then accountancy is very easy for you. So on 1st January 2024, when A Limited took loan, then A Limited will pass bank account debit to loan account. In previous video, I have made you understood that how you pass journal entries with the help of golden rule, and at the end, I also make you understood that what I follow. So bank is an asset and it is increasing, we have debited. Loan is a liability, it is increasing, we have credited. So as per as example, 31st March is books closing date of A Limited, but as per our example, 30th June is the interest payment date. So A Limited will pay interest to X Limited on 30th June, but on 31st March, A Limited is going to make its profit and loss account and balance sheet. So here accrual concept is applicable, and we need to calculate interest for 3 months. So loan is of amount rupees 1000 and 10% is the interest rate, and for 3 months we need to consider interest. So I have calculated interest for the 3 months, that is coming to rupees 25. So as per accrual concept, we will pass this journal entry on 31st March 2024, that is interest account debit to interest payable account. Interest account is expense, so it is debited, and interest payable will be liability of A Limited, and increase in liability we have credited it. This interest is accrued interest. This is called accrued interest. Now coming to 30th June. 30th June is the date when interest is payable by A Limited to X Limited. So on 30th June, A Limited need to consider interest for 3 months again, because for 3 months it has already taken on 31st March. So on 30th June, A Limited is taking interest for 3 months in its books of account. So on rupees 1000 at 10% for 3 months, it is coming to 25 rupees. And as A Limited is paying interest on 30th June to X Limited, so this interest payable liability will be reversed, and as it is decrease in liability, we will debit it. So here you can see we have debited the interest of rupees 25. So interest for rupees 25 for this 3 months, and the earlier 3 months interest rate, that accrued interest is rupees 25, and we are now paying, A Limited is now paying rupees 50 to X Limited. So bank we have credited. So journal entries also I am trying to make you clear along with the accrual concept. Now coming to 31st December, this is the date when A Limited will repay the loan to X Limited. On 30th December, A Limited need to consider interest for 6 months. So on 1000 at 10% for 6 months, interest is coming to rupees 50. As interest is expense, we have debited, and as we are paying through bank is an asset, it is decreasing, so we have credited interest account debit to bank account. Now A Limited will repay loan to X Limited. So loan was your means A Limited's liability. It was credited earlier when A Limited took loan from X Limited. Now it is repaying loan to X Limited. So loan account has been debited and it is being paid through bank. So decrease in asset, we have credited bank. Now, as I said earlier, we have taken one more example. That is, A Limited made a fixed deposit of rupees 1 lakh in XYZ Bank at 6% per annum interest rate on 1st January 2024, and this FD will mature on 30th September 2024. So this is A Limited. It has made an FD of rupees 1 lakh with XYZ Bank at interest of 6% per annum. Now this is the timeline. This is the date when FD is being made, and this is balance sheet date 31st March 2024, and this is FD maturity date. Now let us understand this thing from journal entries. So in this example, 1st January, A Limited made FD of rupees 1 lakh with XYZ Bank. So A Limited will pass entry fixed deposit account debit to bank account. This is increase in asset, it has been debited. This is decrease in asset, it has been credited. Now coming to 31st March 2024, which is the date when A Limited is preparing its balance sheet and profit and loss account. So as per accrual concept, A Limited need to consider interest for 3 months in its books of accounts, as this income is incurring from 1st January to 31st March, because A Limited has made FD on 1st January 2024. So as per accrual concept, income is accruing, hence A Limited need to consider that income. But this is not the receipt of interest, so A Limited will pass this journal entry: interest receivable account will be debited and interest account will be credited. This interest which has been credited is the income of A Limited, that is why it has been credited, and this is called accrued income. Hence interest receivable has been debited because it is increase in asset. A Limited is going to receive interest in future. It is an asset for A Limited. Now this is the maturity date, that is 30th September 2024. This date A Limited going to receive the interest amount and the FD amount. So first of all, A Limited need to consider interest for the 6 months, that is from 1st April 2024 to 30th September 2024. So that is 6 months. So on 1 lakh at 6% for 6 months, interest is coming to 3,000 rupees. So interest receivable account debit to interest income account. Now on the receipt of the interest amount, bank account need to be debited, and here 1500 and this 3000, making this 4500. So bank account has been debited with 4500, and this interest receivable which we had debited earlier need to credit, we need to reverse. So that is why we are crediting. So 4500 has been credited. Now on the receipt of FD amount, bank account has been debited as bank is increasing, and we need to credit this FD account because this was the asset and we are receiving back to our bank account. So there is decrease in asset, we have credited this. Now to summarize, we are recording interest expense for 3 months on 31st March due to accrual concept. Otherwise, we would have recorded interest expense directly on 30th June, as 30th June is the due date of interest payment. Likewise, in our example 2, we are recording our interest income for the 3 months on 31st March 24 due to accrual concept. Otherwise, we would have recorded interest income for 9 months directly on 30th September, because 30th September is the maturity date of FD. I believe that I am able to clear the concept of accrual, and you are not going to have any problem in future with this concept. If you have any query regarding this, you can comment your views in the comment section. Thank you so much. Please like, share, subscribe and hit the bell icon so that you can get notification whenever I upload a new video.